Start off with the next slide then. Okay, today, welcome to the 1AZ Wealth webinar. The topic is the top 11 IRA planning mistakes to avoid. So let's get started. Next slide. My name is Tom Mitchell, and I have the honor of leading the 1AZ Wealth Management team of wealth advisors located here at the 1AZ Credit Union. Our full-time professional advisors are assisting clients and members of the 1AZ Credit Union all over the great state of Arizona. We're very excited to bring you these educational topics directly to you through these webinars and topics that you've asked for. And we've got some events coming up this coming year on Social Security, Medicare, women in investing, and many more. Actually, as a heads up, please make a note of it. On April the 25th, next month, our topic's going to be retirement planning essentials for people that are in their 30s, 40s, and 50s. We decided to make it more focused on the younger and middle group. So people that are in their 30s, their 40s, and people in their 50s. We will be talking about retirement planning essentials during that webinar. So again, April the 25th, put that on your calendar. You'll be getting an invite later coming up in the next few weeks. So next slide. First, here's our informational page. It contains our required legal disclosures for your convenience. You can always check out 1azwealth.com website for upcoming webinar events. Next slide. So for better audio, the webinar is going to be in a listen-only mode. We will be fielding your questions at the end of the webinar, so please email your questions to 1azwealth@1azcu.com. We will be compiling your questions and we'll answer them at the end of today's presentation. If we do not get to your question, I promise you we will respond to you directly. So again, you can scan the QR code right here on the screen, and that'll take you to our website, 1azwealth.com, for more information. You can also connect with us on social media, on Facebook, LinkedIn, as well as YouTube, for more resources and information that we share. Okay, so let's get started. Our 1AZ Wealth topic today, as I said, is on the top 11 IRA planning mistakes. We have Doug Orton joining us as our presenter today. Doug's a little bit about background on Doug. He's a vice president of MFS Fund Distributors, which is a subsidiary of MFS Investment Management. Doug actually joined MFS in 2007 and has actually worked in the financial industry since 1993. He's held roles in sales and tax, compliance, training, as well as marketing. Doug has earned his Bachelor of Science degree in psychology from the Colorado College, and he holds the FINRA securities licenses, the 7, the 24, and the 63. He also has the Chartered Retirement Planning Counselor, the CRPC designation from the College for Financial Planning. So without further ado, I'd like to turn it over to Doug. Doug, are you there?
Awesome. Thanks, Tom. And thanks, everybody, for joining us today. I'm going to go over some of the most common mistakes that people make on their IRA and their other retirement accounts. But before I jump into the mistakes, I want to emphasize two things. One is these mistakes are easier to prevent than they are to fix. So if you think one of these might apply to you, it's not time to panic, because if you spend, 5 or 10 minutes now, in many cases, you can prevent these mistakes from happening. The second thing is I'm going to be sharing rules of thumb, and rules of thumb are great for the people that they work for, but they don't work for everybody. So please don't take anything that I say as individualized advice. It's more of a diagnostic, the idea that, okay, this might apply to me, then go talk to your financial professionals about how it impacts your individual circumstances. But the first one I'm going to talk about is pretty much a universal, which is generally a bad idea to either leave your beneficiary forms blank or let them get out of date. So there's a lot of financial accounts that you can name beneficiaries on. It's not just your IRA, your employer plan at work. In many cases, your bank accounts you can name beneficiaries on with a transfer on death provision. And naming a beneficiary does a couple of things for you. One, it's much cleaner. It avoids probate. It goes to your beneficiaries in a more timely and less expensive manner. And it can be very flexible. If I think about my IRA, I've named my wife Amber as my primary beneficiary. That means she's first in line to receive it. And then I named our children as contingent beneficiaries. And so what that does is if when I pass away, God forbid Amber's died before I did, it will automatically go to the kids. So we don't have to worry about any hassle after I go. Or if she's still around, but maybe for tax purposes, she doesn't want to receive it, she can disclaim it. And when you disclaim an account, you're just saying, I don't want it. It goes to the next person in line. You don't get to name who it goes to. So if she was primary and I didn't name any contingents and she disclaimed, it would go to whoever is defaulted in the document. But since we've named contingent beneficiaries, she can then have it pass right to the kids. So it is a very easy way to build some flexibility into our estate plan.
Yeah. Let me just make
se-
it, go
Oh, yeah,
ahead.
go ahead.
When you're finished, I want to make a couple call outs on this slide.
Okay, great. So the second thing to be concerned about is your beneficiary forms getting out of date. Our life changes over time. You might get married or divorced, you have kids, you have grandkids, and all these things might change who you want to receive your account. And making sure that you've changed your documents to match is incredibly important, because the way you fix an outdated beneficiary is generally to have the outdated beneficiary disclaim the account, which sounds simple, and it is if they agree, but the most common outdated beneficiary I've run into is an ex-spouse. And I have never seen a case where an ex-spouse disclaimed so that spouse number 2 can receive the IRA. Maybe it's happened, but I haven't seen it. Luckily, spending 5 or 10 minutes now making sure your beneficiaries are up to date helps make sure that this isn't a problem that your heirs run into. So Tom, you had a point?
Sure. I will tell you, of all these mistakes that we're going to go over today, this is a big one. Every year, every single year that I've been in the business, I've come across this where someone has failed to update a beneficiary designation, or they've overlooked it. And this is a common thing. We many times will have accounts scattered around. We'll have accounts in different IRAs with different firms. And the reality is we'll miss one. And the cleanup at the end is difficult and challenging given some of the estate settlements that I have to go through and some of our advisors work with clients on. So please, I urge you, please take a good hard look, make sure those beneficiary designations are up to date and actually are to the people that you want them to go to, because that's critically important.
Great point. So our second mistake is related, and this is the mistake that sometimes beneficiaries make after they inherit the account, because most of us understand how the taxes work on our own IRAs, right? If I decide to take money out of my IRA, I realize that that's generally going to be taxable income to me. When my heirs inherit my IRAs, when they take money out, it's going to be taxable income to them. And unfortunately, what we see a lot of beneficiaries do is take all the money out in the year they inherit it. And if you picture somebody inheriting a $300,000, $400,000, $500,000 IRA, taking all that money out in the first year, that causes massive tax problems. Because if I liquidate a $500,000 IRA in a single year, doesn't matter what tax bracket I started in, I'm going to end up in the maximum tax bracket. So that can cause problems. And the sad point about that is that most beneficiaries have at least a 10-year period to liquidate the account. And you can imagine if I inherit that $500,000 IRA, taking that over 10 years, so maybe 50,000 a year plus whatever the growth is, that's a much easier tax liability to handle than taking all of it out at the beginning. Now, for accounts that you inherit, knowing that you have those options, that's a great place to start. But what about our kids or our other heirs? They might not know about these rules. And
Mhm.
do we really want to sit down with them and try to teach them all the different rules? Maybe. But I think the other thing you can just suggest is that they get advice before they make any decisions about these types of accounts. Because as long as they talk to somebody about the rules before they take any money out, they can come up with a plan. Some people, that'll be spread it out over the full 10 years. Some people, it might be leave it alone and take it all out in the 10th, or some combination of those. It's a very individualized decision and can help out significantly with their tax liabilities. So we're going to move to mistake number 3, which is spousal rollovers. So spouses have more options than other beneficiaries when they inherit retirement accounts. And what option is appropriate is really going to depend on when you inherit the account and what your spouse's age was compared to yours. And I think it makes the most sense if I use an example. So I'm slightly older than my wife. So if I die at a reasonable age, let's say I'm 87, she's 85, she has the ability to roll my account into hers. And that's probably a good idea because we'll talk later about required distributions. There's a percentage of your account once you're 73 that you have to take out, and it's based on your age. And the younger you are, the less you have to take out. So if I die at 87 and she's 85, she rolls my account into hers. That lowers the amount she's forced to take out. That's probably a good idea. And that's become the default option for a lot of spouses. But if instead of dying at a reasonable age, I died today, Amber probably doesn't want to use that option because if I died today, she rolls my accounts into hers. And then, as a young widow needs to take any money out, she's got to worry about the early distribution penalty, which we'll get to exactly how that works later. But it's a 10% penalty for taking money out before you're age 59 and a half. So she might want to use the option where she leaves it as an inherited account. So she would re-register it. So it says Doug Orton's IRA deceased for the benefit of Amber Orton. She gets to pick the investments. She decides when withdrawals are taken out and how much. The big difference is all the money she takes out gets coded as a death distribution, never subject to the early distribution penalty. And for my Roths, she would be able to take the money out tax-free. So it's a much better option if you're young and you might need to take the money out. And to make it a little better, her ability to treat my IRA as hers doesn't expire. So she could just wait until she's 59 and a half and then re-register it into her own account. And so now anybody who inherits from when they're under 59 and a half generally uses the inherited account. Over 59 and a half, they roll it into their own name. Next year, it's going to get a little bit more complicated because Secure 2, which was a tax act that passed last December, gives spouses a third option where they get to hold the account in a special status where they get to use the deceased spouse's age for RMD purposes. We don't know exactly how those accounts will be registered or anything like that. It's not taking effect until 2024, so we'll have to wait for on the IRS for details. But the important part about that is starting next year, there's going to be 3 very different options. And for most beneficiaries, spousal beneficiaries, one of the 3 is clearly better than the others. So it's another example of when your spouse passes away, getting advice before you make any decisions about that account can give you more tax flexibility and match it to your own individual needs. So moving on to mistake number 4, not using a direct transfer. There's multiple ways to move money between retirement accounts, and the short version of this is going direct is better for most scenarios. And what we mean by direct is if I wanted to move money from one of my IRAs to a different IRA or a new IRA, going direct means IRA 1 pays IRA 2 directly. I never receive the money. And it's very hard for that to go wrong from a tax perspective. There's no time limit, there's no withholding. They just send it as a wire between the two institutions. Very hard to make that go wrong. My second option is an indirect transfer where I have IRA 1 pay me, then I cash that check, and then I deposit the money into IRA 2. If I do it that way, I have 60 days to complete that transaction. I go to 61, 62 days, it becomes a taxable distribution. And if that's not what I meant to do, that's not great. And I can only do that once in any 12-month period. So if I do that and then later, 6 months later, I do something else and I realize, oh, I really need to put this back, I can't. So going direct between IRAs, generally a safer option. Going from an employer plan like a 401k to an IRA, the issues are a little different, but still safer to go direct. So if I wanted to take $100,000 from my 401k and put it into my IRA, I could do what is called a direct rollover. My 401k pays my IRA $100,000 and I'm done. Or I can go indirect. I'd take $100,000 withdrawal from my 401k. First problem is I'll actually only get a check for $80,000. There's 20% mandatory withholding. So that $20,000 will go to the IRS, $80,000 goes to me, but I need to get $100,000 into my 401 into my IRA. Where's the other $20,000 come from? That's our first problem. Second problem is it shares that same 60-day deadline. So I do need to do it relatively quickly. Now, I don't have the once a year issue, but as you can see, going direct is just cleaner. And then the last thing I want to say about rollovers and indirect rollovers is non-spousal beneficiaries can never do indirect rollovers. So let's say I inherited an IRA, I took the money out, then I realized this is going to be a huge tax problem. I can't put it back because I can't do an indirect rollover. So when I said in the opening, some of these mistakes are easier to fix or easier to prevent than they are to fix. Some of them are impossible to fix. Once they're done, they're done. So be very careful when you're moving money between retirement accounts. And if you're unsure of any of the rules, getting advice before you start the transaction can save you a lot of trouble later. Moving on to mistake number 5, net unrealized appreciation. There is a very special tax treatment that you can use on your own employer's stock when it's coming out of that employer's retirement plan, like a 401k. And the short version is the growth that happened on the stock while it was in the plan. If you take the money out in exactly the right way, you get to pay long-term capital gains taxes on that growth instead of ordinary income tax rates. And long-term cap gains rates are roughly half, in most cases, of what ordinary income tax rates are. So it can be a significant savings. However, there are very, very specific rules that you need to follow in order to get access to this treatment. So in general, if you've got your own employer's stock inside your 401k, there's 2 questions that you need to ask your financial advisor, potentially your tax advisor as well. One, what's NUA and should I take advantage of it? How do the rules work? And they can talk about for your individual plan, your situation, whether NUA fits. The second thing to ask is, do I own an appropriate amount of my employer stock? Now, I can't tell you what is or isn't appropriate for your individual circumstances, but I can tell you that humans are systematically wired in a way that makes us make sometimes bad financial decisions. And one of the mental biases we have is called familiarity bias. The more familiar we are with something, the less risky we think it is. Think about flying versus driving. Statistically, flying is a much safer way to travel long distances. But many of us are a little nervous flying, but we're not at all nervous driving. Because we drive all the time, we underestimate the risk of driving. Because we don't fly that often, we overestimate the risk of flying. That same thing can happen with your employer stock. You're very familiar with your employer, so you underestimate the risk that that stock poses to your overall financial plan. And again, I can't tell you whether the amount you hold is appropriate or not, but we do know that things like the internet crisis or bubble, the financial crisis of 2008, a lot of people ran into a situation where they owned a large amount of their own employer stock in their 401k. And because of whatever was happening in the economy, that company ran into a lot of trouble. Their 401k balance got hit real hard and they got laid off at the same time. That's not great. So if you're unsure whether it's appropriate, that's a question that I would definitely ask your financial professional just to see. Maybe what you hold is perfectly appropriate. Maybe it's not. There are things you can do to protect yourself from that risk. Moving on to mistake number 6, not using a Roth or Roth IRA or Roth 401k. Roths are kind of the opposite of a traditional retirement account. So when I put money into my traditional 401k, I get a tax benefit up front, then it grows tax deferred, but when I take it out, it's taxable. The Roth is different. When I put it in, there's no tax benefit up front, then it's going to grow tax deferred. But if I take it out the right way in retirement, it's tax free. So one has a tax benefit up front, one has a tax benefit at the end. Whether one or the other is appropriate for you is going to vary a lot based on your individual circumstances. So if you're late in your career and you've got a pretty high income, pretty high tax bracket, and maybe when you retire, it'll be a little lower, the traditional IRA or traditional 401k is generally a better option. But if I were a younger employee where maybe I'm not making as much, my taxes are lower, and I have a really long time for this to grow tax deferred and tax free, then the Roth tends to come out ahead. So it's worth looking at, is one better than the other, or do I want to own a mix of both? Because the Roth can really give you a lot of tax diversification in retirement, because we don't consider taxes as a risk in retirement, but they really can be. One of the problems that a married couple can run into is what we call the survivor's tax trap. When the first person in a couple dies, the survivor has to start filing a single tax return. So in a lot of cases, their income goes down a little bit, but their tax rate goes up. That's not great. And because your Medicare premiums are also based on your income and your filing status, sometimes your Medicare premiums go up as well. And sometimes the percentage of your Social Security that's taxable also goes up. That's what we call the survivor's tax trap. Having some Roth can then be used to protect the survivor after the first person passes away. Moving on to mistake number 7, not maximizing your contributions to your IRA or your 401k. I'm actually going to disagree with this slide. It's a little awkward because I wrote this slide, but not everybody should maximize their IRA. Some people don't need to meet their long-term goals. Some people need to save more than the maximum in their IRA or 401k to meet their long-term goals. Whether you need to do less or more, if you haven't asked these 3 questions, you're not going to know. And those 3 questions are, when do I want to retire? How much income will I need to support my lifestyle after I retire? And then what steps do I need to take to make those 2 things match so that my retirement income and my retirement income needs are the same? Or if you have a little bit more, that's not a bad thing either. So if you don't know how to do that math or you're a little intimidated by it, that's something the team can help you with and definitely can get you on track to meeting your long-term goals. Just because if you don't know what your target is, it is very, very difficult to hit it. And if you find you're in a situation where you need to save more than you can in the IRA or the 401k or whatever plan types you have, there are plenty of other options that you can save in. So it is definitely a doable thing if you have the math run and decide to make steps in that direction. Mistake number 8, spousal contributions.
Mhm.
You have to have earned income to make IRA contributions, but it doesn't have to be your earned income. It can also be your spouse's. So let's say you're married and you're outside the paid workforce right now, caring for young children, caring for a sick family member for whatever reason. You're not earning any income right now, but your spouse is. You can still make IRA contributions. And just because you're outside the paid workforce doesn't mean you shouldn't have a retirement income plan. You should. And an IRA is a tool that you can still use to meet those goals. So moving on to required minimum distributions. Once you turn 73, you have to start taking money out of your IRA. And in most cases, your 401ks and other plans as well. And if you don't take the right amount out, there is a 25% penalty that sometimes can be lowered to 10%. That's a brand new change. Last year, the penalty was 50%. This new penalty regime is new due to Secure 2. And so because of that, I can't tell you when the 10% applies versus when the 25% applies. We haven't gotten that information from the IRS yet, but to me, doesn't really matter, right? Either one of those is not a great outcome. It's better to avoid the penalty completely. So the first thing is you just want to take those distributions once you're required to. And second, understand the rules between different types of accounts, because IRAs are actually the easy ones. If I've got 3 different IRAs, and let's say I need to take 10,000 out in total between all 3, doesn't matter which accounts I take it from. I can take all 10,000 from one, I can take 5,000 from this one and 5,000 from that one, doesn't matter. As long as I hit that number, I'm good. But 401ks, other plans like that don't work that way at all. If I've got 3 old 401ks, and let's just say I needed to take 5,000 out of each of those plans, and I took 15,000 out of one of the plans, well, that one's met because I took more than I needed to. The other 2, I needed to take out 5,000, I took out 0. So each of those was a failure. The failure in total would be $10,000. That means the penalty would either be $2,500 or $1,000. Not something that we want to deal with. So one thing to consider as you approach age 73, if you've got a lot of accounts scattered around and you don't have any compelling reasons to have all these different accounts, consolidating down can make these mistakes less likely. It's what I did with my parents when they were approaching age 70 and a half, which was the RMD age at the time. We got it down to 1 IRA for my mom, 1 IRA for my dad, set it up on automatic distributions. So the IRA company calculates the RMD at the beginning of the year and sends it out to them as monthly checks or deposits. Now they don't have to worry about the penalty. And the other benefit of consolidating account types is now things like making sure my beneficiaries are up to date, all those administrative things are also easier.
Mhm.
Coming into the final stretch here, we've only got 2 left. Mistake number 10, not considering qualified charitable distributions. Qualified charitable distributions are a tax strategy that allows you to take money from your IRA and make charitable contributions once you've hit the age of 70 and a half. And they don't count as taxable income to you, but still count towards your RMD requirement. And that might not sound like a big deal, right? Because you say, okay, if I wanted to give $10,000 to the American Cancer Society, you're saying I can take $10,000 from my IRA, pay the American Cancer Society directly, and it's not taxable to me. But maybe I could just deduct it, right? So instead, I take the 10,000 out, then I pay the American Cancer Society the 10,000, and the deduction and the withdrawal cancel out. That's true for some taxpayers, but not all. Not everybody gets to take full deductions for charitable contributions, particularly after the tax changes in 2017. So this might be a better way to make charitable contributions. And in all cases, it's never less advantageous than a deduction. You can only do 100,000 of gifts per year this way. For most of us, that fulfills any charitable giving that we're going to do. And last thing I'd say is I'm not suggesting that you give away your IRA just to avoid taxes. It's just if you're already making charitable contributions and you're over 70 and a half, this might be a more tax efficient way to do it. So you could either give more for the same cost to you or give the same amount to the charity at a lesser cost to you. So let's go to our last mistake, mistake number 11, and this is paying unnecessary penalties. Earlier, I said in many cases, when you're below 59 and a half and you take money out of a retirement account, there is an extra 10% penalty. But there are a lot of exceptions to the penalty. We're at either 15 or 16 now. There's almost too many to keep track of. And these aren't loopholes. They're the way the law is meant to work. So it's perfectly legitimate to use these strategies to avoid the 10% tax. Now, the key is getting advice before you take the distribution, because some exceptions are only from specific types of accounts. So let me give you one example, because I think it's the best one to illustrate this. For your employer plan, so your 401k, 403b, that plan you have at work, if you leave that employer after January 1st of the year you turn 55, that particular plan is no longer subject to the 10% early distribution penalty, but only that plan. So let's say I was 56 years old and I got laid off from MFS. So I'm not that happy with them. So I pull the money out of the 401k as soon as I can, and I put it into my IRA as a direct rollover. Well, the direct rollover, that's not a taxable event at all. But now let's say I need to take money out because now I'm unemployed. I need some money. I need to take it out. How do I avoid the 10% penalty? There might be a way I can do it in the IRA, but if I had just left it in the 401k, I separated from service after January 1st of the year I turned 55, that plan's penalty free. So you don't need to memorize all 16 exemptions to the penalty. Just know that these penalty exceptions exist, and there are many times where you don't have to pay the penalty if you get advice before you take the distribution. So those are the 11 mistakes I wanted to talk about. Before we get to questions, I'm just going to close with the two things I opened with. One, these mistakes are easier to prevent than they are to fix. As I was going through any of those mistakes, if you thought, oh, that might apply to me, take some time now, review your accounts, get advice when you need it, and hopefully you can avoid those ever happening to you. And secondly, what I shared were rules of thumb. If anything I said sounded like advice to you as an individual, I apologize. That is not what I meant. This is more of a diagnostic. If it might apply to you, get the advice you need now at an individual level, because some of the things I said that might sound like, oh, this is the right way to go, might be the right way to go for 90% of the people on the call. And that's great. But if you're in that 10% it doesn't work for, it can be its own mistake. So with that, I want to thank you for your time. Happy to answer the questions that were emailed in.
Sure. Well, we've got a lot of questions that have come in, folks, about last count was about 18 emailed in. So we're going to touch on those emailed questions. But before we get to the questions, Doug, I'd like to just make a reference to a point, and one of those 11 mistakes that people make often is not planning the taxes, right? Not planning the taxes on those inherited assets. And we talked about some strategies there, but let me share, just take 1 minute here and share a real life story with a case where we had a client where they had about $200,000 in their IRA, and their goal is to pass this $200,000 to the 2 adult children that they have. And so the phrase is, we want to be equal, right? We want to treat our children equal and fair. Well, and actually, in further discussing the process with them, we discussed, equal necessarily doesn't mean fair. So let me explain. One of the adult children was in a very high tax bracket, close to 40%. The other adult was not in a very high tax bracket at all, maybe in about a 12 or 15% bracket. So if they played it out and said, well, let's be equal, so they both get $100,000 when I pass on this IRA. Well, one would get the $100,000 and actually would pay 40% of it, $40,000 to the government. So they would only have $60,000 after tax. The other adult child would get the $100,000, pay the 15% tax or $15,000, and actually would have $85,000 after tax. The question is, were they really equal? No. Were they really fair? Well, they attempted and tried to be. Well, there's better ways to manage that and think through that. Even if the grandchildren are involved in this equation, that can even impact them even farther. So that's just one example of really thinking through the ultimate effects of tax planning when we have an IRA account. Because these IRAs, they've been grown and grown, and our 401ks have grown and grown to be quite large assets. And we've grown those to the point where we now have to think about what is the most effective way to distribute those assets in the most appropriate after-tax way. Maybe it's skipping the adult children and just naming the grandchildren as the heirs, because that's who's going to ultimately get it. Maybe that's who we should send it to or list as the beneficiaries and escape or really, really lower down the tax brackets substantially. So even more assets get passed down to the true heirs that we want. So these are the little tax planning things you need to think about. That's thousands and thousands of dollars that went unnecessarily to the government in a tax scenario that could have been avoided, right? So that's just a quick little example of just one little nuance that some of the things you talked about, Doug. All right, so we've got lots of questions to get into. Thank you for holding on. As I said, we've got 18 questions. These are real live questions. So let's get into them. First question, Doug, was, is it okay to have a minor as a beneficiary of my IRA? Okay.
Yeah, that's a question I get all the time. And the quick answer is, yeah, it's fine to have a minor on as a beneficiary. I dealt with a lot of those back when I was in tax compliance. And, the courts figure this out all the time. There'll be a financial guardian named, and it generally works out just fine. It's a little bit more complicated. The other side of that is, if you have minor children, working with your advisory team and your lawyer to have guardians named and trusts, if that's necessary, probably a good use of your time and resources. But if you want to name your minor children as beneficiaries, it generally does work out okay.
Great, great. Now, again, any of us that are on this call now, if you have a question, please email it in to 1azwealth@1azcu.com, and we will try to get to it tonight. If we don't, we will call you or directly answer it with you individually. Some of the questions we did get in are personal in nature. So some of them I'll address and we'll talk about, and some we'll have to address individually and personally because we don't want to divulge personal information. Here's the next question. Should I convert my IRA into a Roth? Wow, we talked a little bit about Roth already. Do you want to maybe talk more on that?
Yeah, so that's a big it depends question.
Yeah.
And it's this whether you want to convert an IRA to a Roth is kind of the same thing when I was talking about whether you want to put new money into the traditional or the Roth 401k. So generally, the longer it's going to be in the account, that is an advantage to Roth. And then your likely tax brackets, a low tax bracket now versus a high tax bracket later, that would bias it towards the Roth. Low tax bracket in the future, high tax bracket now would emphasize it towards the traditional. And then having a mix of both works out for a lot of people, but there's really no way to tell whether you should do that until you look at your full financial plan.
Yep. All right. Another question is, should I fund my IRA or start saving for my daughter's college? Wow. We get this all the time. Go ahead. Do you want to make a comment? And I can also share.
Yeah, I would say this is partially a philosophical question and partially a math question.
Yeah.
So part of it is it's your money and you get to decide, is my own retirement a more important financial goal for me or my kids' education? That's 100% up to you. That's what I mean by a philosophical question. Sometimes what people mean though is, can I afford to do one or the other? And that's where you want to maybe look at your plan. Because for some of us, we can afford to do both. And that's something you can work out with your advisory team. Other people need to pick one or the other. So it's just a decision you need to make as an individual.
Sure. I'll just add one thing to that. I agree with what you're saying, Doug. The personal decision, though, we see from time to time, people want to give so much to their kids, right? We all want to do the best we can and make life easier for them. Be aware what you do, though, is going to impact you and your life later. So it is critically important to plan for you first and then look at the children. I'll use this as an example. Anyone's been on an aircraft, right? And if you've been on an airplane and one of the emergency drills are, if we have cabin decompression, these masks fall from the ceiling, right? So what do they say to do? Please put the mask on for yourself and then you put it on for the children. So you've got to think about you first because you're closer to retirement than your kids are. So it's critically important to think through that process. So there's you go. All right, next question. Should I, how often should I review my accounts? Okay.
So I would say you want a balance.
Mhm.
Too often, particularly if you mean you're checking your balance, there's a lot of psychological research that if you check your balance all the time, it creates more stress and more unintended consequences. So if you mean, should I check my balance all the time? Probably not. But I think going in there twice a year, once a year to make sure, do my investments still match my long-term goals? Have I reviewed my beneficiaries at a reasonable length of time? Those are great. So it doesn't have to be a lot. Once or twice a year, you can generally get what you need done.
Yeah, you mentioned a good point, twice a year. Well, my wife and I actually started this many, many years ago. Our birthdays happen to be 6 months apart. So that's our balance sheet time when we look at our accounts and assemble everything and take a good hard look at where we are. So it's that 6-month checkup that we do twice a year, which is a good way of doing it. Okay, next question. I have both an IRA and a 401k with my job. And like in 2008, could I lose all my money? So the question is, I should start off, can I have both an IRA and a 401k in my job? I didn't read the first part there.
Yeah, so you can absolutely contribute to both a 401k and an IRA. They're two separate limits. You can absolutely use both. And then to the second question, I assume that means they were in the equity market and there was a steep downturn in 08. Depending on what market you were in, it was 40 or 50%. And it took about 3 years to get back to even.
Mhm.
And so that's one of the reasons, if you've done any of the questionnaires on your 401k, they start asking you about your time horizon. How long is this money likely to stay in the account before you need to use it? That's why. You want to make sure that you have enough time before you need the money to get a recovery from any sort of downturn like that. So that's my way of saying you want to make sure that your goals, your risk tolerance, your time horizon all come together to figure out what the appropriate investment is for you.
Sure. All right, another one is, here's one. I'm 46 years old and I want to be financially able to retire at age 60. $9,000 in a 401k with a company, and I don't work for anymore. What do I do? Well, again, that's more of a personal question. I think we talked about, Doug, is that the key is you're recognizing you've got to do something. You're age 46. You have a goal at age 60. That's 14 years away. So it's critically important to do some planning and to really look at it and have some analysis done to determine, can I get to a level of assets that's going to give me a comfortable income that I'm going to be able to live off of for the rest of my life, right? So that's a critical
Absolutely.
process. It's a process. It's an individual thing. And I urge you to meet with one of our advisors or any of your advisors and really talk through this, because 14 years is not a long time. The sooner you can take action, the better, though. So thank you for asking that question. Next question. I took money out of my 401k to purchase a retirement condo. I would like to reinvest the money when the home sells. What's best? You have a thought, Doug?
So, yeah, so I would say we can't define what, if what they mean is where do I invest that money? That's all going to be driven by the goal. Is this a goal for retirement? Is this so that's where I would start. What's the goal for the money? And then if they mean, can I replace it in my IRA? We talked about that. That's a 60-day deadline to do that. So depends on the goal, depends on what type of account it was. So I think that's one where they really need to sit down with somebody and do a little bit of planning.
Exactly. Here's another question. I have an IRA account with a national brokerage firm that I am unable to do anything with proactively. Can 1AZ help? Well, the answer is yes. We can certainly help. We'd be happy to do an analysis, review your accounts, and really do a risk assessment to determine what your goals are, how risky you would like to be, and then plan out accordingly and decide what's best for you. So the answer is yes. All right, next is pitfalls of transferring monies to heirs before death or after.
Oh, that's a great one. So that's going to depend on what type of accounts they are. Generally, for your retirement accounts, you can't transfer those to heirs before you die. I mean, you could, let's say, take money out of your IRA, pay the taxes, and then gift it to your kids. That may or may not be a good idea. Probably depends a lot on if you're in a really low tax bracket and they're in a high tax bracket, that might make sense. If you definitely know you don't need the money. Then for your other types of assets that are what we call non-qualified assets, that gets a little tricky because let's say I own a large portfolio of stocks. When I die and I leave it to my heirs, the number that you use to calculate the taxes due, it's called your tax basis, resets to the value that I died on the day I died. So if I have something I didn't pay a lot for and now it's worth a lot, leaving it to my heirs after I die can drastically lower the amount of taxes due. So sometimes that it's a good idea. But if I'm younger and I have an asset that I think is going to appreciate a lot, gifting it to my kids now so that the appreciation happens after they get it, that can be an advantage. So it really depends on what the asset is, whether it's got a high or a low tax basis, and kind of what your long-term goals are. But it's definitely something that you want to look at when you're developing your estate plan. Gifting while you're alive, perfectly appropriate strategy that a lot of people do use.
Sure, sure. All right, next question is IRA versus a high compounded interest rate savings account.
So this one,
Yes.
there's a common perception that an IRA is a specific type of investment, and it isn't. An IRA is a type of account that you can buy a lot of different investments inside. So if you determined that a high interest savings account was appropriate for your needs, you could buy that inside the IRA. Or if you decided I should buy mutual funds or ETFs or stocks or bonds or a lot of different, you buy it inside the IRA. So the investment choice that you make, you can buy almost anything inside an IRA. You can't buy, artwork and collectible coins or life insurance. That's pretty much what you can't buy. Almost everything else works.
Sure, sure. And another call out too is that high compounded interest rate savings account, if it's not inside the IRA, it would be outside the IRA, and that would be usually a taxable event. So they're going to be paying taxes on that interest. So do you want to pay tax now or defer the tax? Or if it's in a Roth IRA, not have tax at all when you take the money out. So there's a lot of variations there for sure. Okay, here's a number. Okay, I need to select an IRA for a 69 and a 63-year-old. Oh, I wish I had more to that question, but that's all they wrote. So I need to select. Well, yes, that's a personal decision. Can you have them? Yes. At those ages? Yes. What's best? Well, it depends upon your situation, your current income, as well as your future income and your future tax brackets. Would love to sit and talk to you more about that, and we'll get a hold of you. Here's another question. I'm 44 and I need to plan more aggressively. Have any suggestions on how to save aggressively without having a lot of money to start? Well, yeah, that's a great question. I'm so happy they're asking it at age 44. So yes, you have time. So critically important, sit down, do a risk assessment, determine how risky you want to be. We call it the sleep factor. Depending upon how much risk you can take will help determine how much sleep you can take and have. So if you can sleep comfortably with a lot of volatility, great. If you can't, then it's usually back down a little bit to a little bit more conservative approach. But yes, the answer is there are some strategies, and yes, there's a way to get started with a little bit of money. So urging you to start now versus waiting later. Okay, next question. How to handle a younger wife's small IRA based on our situation? Well, I guess I would say again, Doug, we need more information. The younger wife has a smaller IRA. Well, is there income needs? How much younger is she compared to you? Is there a death issue potentially in the horizon here that we need to be thinking about? All those scenarios. But yes, there's lots of different scenarios and how they can be handled. And we can talk about that on an individual basis. Okay, here's another one here. What's the best advice you have for choosing between an employer-sponsored IRA in addition to a 401k and an independent Roth IRA? Well, okay.
Yeah, so I'd say the first thing to look at is if your employer plan has a match. So a lot of times a plan, if you put in 5%, they'll put in 5%, or if you put in 5%, they'll put in 2.5%. There's different formulas. In general, putting in enough to that employer plan to capture the entire match will almost always come out ahead. So first step, make sure you're putting enough in the employer plan to capture the match. And then after that, you just base it on, okay, if the 401k has the investment options that I want and I need, maybe I save a little bit more in there. If not, then I go with the IRA because that has almost unlimited options. So I'd say capture the match first and then base it on the options that you want to use and what plan they're available in and go from there.
Okay. All right. Well, there's two more that I'll ask. One is I received a beneficiary amount. So I'm assuming this is a beneficiary IRA. It says I received a beneficiary amount that's in a growth fund with a major mutual fund company, 30 years plus. Is it the best option for growth? Wow, that's an open-ended question, but love to talk to you more about it because there are lots of different kinds of growth funds, different mutual fund companies, clearly. And really, what is the most, that may have done very well for you for the last 30 years, but the question is, where are you now in your stage of life for the next 30 years, for example? So we need to think through that and plan accordingly. So we can give you some good ideas and good suggestions on that. Okay, last one is, I am 62. I have a simple IRA for my wife and myself. Can I also contribute to any other retirement plans?
Yes. So you can make contributions to a simple IRA and an IRA, or if your income is within the limits, a Roth IRA. And if putting the most you can into the simple and the most you can into the IRA doesn't meet your savings needs, there's plenty of other vehicles, non-retirement vehicles that you can invest in that don't have any limits at all. So I'd say the simple answer is yes. There's a lot of different plan types you can use. And in many cases, you can mix and match even different retirement accounts perfectly appropriately.
Sure. Well, listen, Doug, thank you. I don't know where our hour went. We buzzed through this. We have a couple minutes left, but wow, what a great time. Thank you so much for your time and sharing so many of your insights and really talking through those big 11 mistakes people make. And we just kind of talked about even more that people can make. So again, thank you for that presentation. And thank you all that are watching right now and listening in. Thank you for joining. We hope this discussion has helped you, given you a little better insight on some of the key IRA mistakes to avoid in your retirement. You know, we're all here at One Easy Wealth Management welcoming your feedback and comments. As always, please email us with any suggestions you have on future webinar topics. Tonight's topic was asked by a number of people. That's why we brought it. So we need your feedback. And again, our wealth team of advisors stand ready to assist you in reviewing your current financial plan and portfolio in light of today's economy. There is no better time than the present to get a second opinion, take a look at your plan, make sure all of your thoughts, needs, wishes, and desires are being thought about and addressed. Many of our clients have had advisors with others when they first come to us. But what they've learned and discovered, some of the new ideas, new strategies that we present actually better suit and better fulfill their needs. So we welcome your call. So call us at our toll-free number at 877-566-0517 or visit our oneazwealth.com website for lots of information that you can pull down. We've got videos out there, we've got calculators, and additional resources are available right there on our website. Again, I want to thank you for joining us. From all of us here at One AZ Wealth, we want to wish you the very best for 2023. We wish you for your safety, your health, and your wealth. So take care and look forward to hopefully seeing you on April the 25th for our next webinar. Again, take care. Bye-bye.